Welcome back to Boni's Life, the channel where we decode the crypto markets so you don't have to lose sleep over them. I'm Boni, and if you're new here, do yourself a favor and hit that subscribe button right now, because what we're about to cover this week is not something you want to miss. This is the week that could define the direction of the entire crypto market for the next quarter. So grab your coffee, sit down, and let's get into it. Before we look ahead, we have to look back, because the past week in crypto was, to put it diplomatically, a roller coaster with no seatbelts. Let me give you the numbers straight from CoinGecko as of Sunday, March 8th, 2026. The total global cryptocurrency market cap sits at $2.39 trillion, down 0.6% in the last 24 hours. Bitcoin dominance stands at 56.7%, meaning Bitcoin is essentially eating the entire market for breakfast right now. The 24-hour trading volume is $60.17 billion. These are not small numbers, people. Now let's talk about what actually happened this past week. Bitcoin opened the week around $65,000, surged all the way to $74,130 on Wednesday, its highest level in over a month. And then, as if someone pulled the emergency brake, it slid back down to around $68,700. As of right now, Bitcoin is trading at $67,813. That is a weekly gain of about 3.8%, which sounds great until you realize that most altcoins went the other direction. Ethereum dropped 1.9% on the week to $1,968. Solana fell 2.4% to $83.29. XRP lost 1.1%, sitting at $1.37. And Cardano? ADA dropped a painful 10.3% to 25 cents. So yes, Bitcoin season is very much alive. What caused that midweek Bitcoin spike to 74,000? Two things collided at once. First, a massive short squeeze. Over $408 million in leveraged short positions were liquidated in a matter of hours as Bitcoin surged. That is the second largest short liquidation event in 10 days. When shorts get squeezed like that, the price moves fast and furious. Second, there was a brief moment of optimism around the geopolitical situation in the Middle East, which I will explain in detail in a moment. But here is the key lesson. That spike to 74,000 was not sustained. Whales, the large wallet holders controlling between 10,000 and 10,000 Bitcoin, used that price level to take profits. Sentiment data shows that whale transactions spiked to 4,269 on the day Bitcoin hit its local top. That is the highest whale activity in a month, and it was almost entirely profit-taking. Meanwhile, retail traders were buying the dip. When whales sell and retail buys, history tells us the correction is not over. Now let me give you the technical picture, because this is where it gets really interesting. Bitcoin is currently trapped in what analysts call a bear flag pattern, a consolidation structure that has been forming since Bitcoin's all-time high of $109,000 back in October 2025. We are now approximately 38% below that peak. The critical resistance level that every serious trader is watching is $72,000. According to the team at investing.com, and I quote, "A high volume close above 72,000 eliminates the bear flag thesis and opens the path to $79,000 to $80,000. Below 72,000, the bear flag remains intact, and the measured downside target of that pattern points to $42,000 to $45,000. The support floor is at $62,300. That level held during the February 24th flush to $62,920. The 50-day moving average has crossed below the 200-day moving average, what traders call a death cross, confirming the intermediate downtrend. The RSI sits at 46.14, neutral, not oversold. The crypto fear and greed index is at 14, deep extreme fear territory. And here is the thing about extreme fear. Historically, it is where long-term wealth is built, but it is also where impatient traders get destroyed. 38% of all altcoins are currently trading near their all-time lows. This is not a casual dip. This is a full-scale altcoin bear market running alongside a Bitcoin consolidation. Now let's talk about why the market is behaving this way. Because the fundamentals and the macro environment are the engine driving everything you see on those charts. And right now, that engine is running on a very complicated fuel mixture. The single biggest macro event of this coming week, and arguably of the entire month, is the United States Consumer Price Index report, releasing on Wednesday, March 11th. This is the February inflation data, and it will set the tone for everything that follows. The consensus forecast is for core CPI to rise 0.2% month on month. Here is why this matters so much for crypto. A hotter than expected reading, say 0.3% or above, would push Federal Reserve rate cut expectations further into the future, strengthen the US dollar, and put downward pressure on Bitcoin and risk assets broadly. A cooler reading, 0.1% or below, would do the opposite, weaken the dollar, boost rate cut hopes, and likely send Bitcoin testing that 72,000 resistance level again. This is a binary event. You need to be positioned before it drops, not after. Then on Friday, March 13th, we get the US Core PCE Price Index and the Q4 2025 GDP second estimate. The PCE is actually the Federal Reserve's preferred inflation gauge, so a surprise in either direction here could move markets just as sharply as the CPI. And on Thursday, March 12th, the New York Federal Reserve is scheduled to inject approximately $13.4 billion in reinvestment purchases and $40 billion in reserve management purchases into the financial system. That is $53 billion of liquidity entering the market in a single day. Liquidity injections of this scale historically support risk assets, including cryptos in the short term. Now, the elephant in the room. Or should I say, the elephant in the Strait of Hormuz. The US-Israel military conflict with Iran, which entered its second week as of this recording, has fundamentally changed the risk landscape for all financial markets. Brent crude oil has surged to $90 per barrel, the strongest weekly move in years. Gold has reached $5,174 per ounce. The VIX Fear Index sits at 24.94. CNN's David Goldman summarized it well. The conflict is creating a dual threat of rising gas prices and renewed inflation pressure, which complicates the Federal Reserve's path to rate cuts. For crypto specifically, Bitcoin's correlation with US technology stocks remains elevated at 0.55 on a 30-day rolling basis. That means when the Nasdaq sneezes, Bitcoin catches a cold. The geopolitical risk premium is real and it is not going away this week. On Monday, March 9th, China releases its consumer price index data. China has been flirting with deflation for months. The January reading was just 0.2% year-on-year. If the February data shows further deflationary pressure, it signals weakening global demand, which is negative for risk assets. Also on Monday, Japan releases its final Q4 2025 GDP estimate. Japan's economy contracted in Q3 2025 at negative 0.7%. A second consecutive negative reading would technically confirm a Japanese recession, which would ripple through Asian crypto trading sessions. On Tuesday, March 10th, South Korea's Digital Asset Task Force releases its integrated plan for crypto regulation. South Korea has one of the highest per capita crypto participation rates in the world. Its regulatory framework directly affects exchange listings, trading volumes, and project development decisions across the entire Asian market. This is a regulatory event that most Western analysts will overlook, but you should not. On Saturday, March 14th, Polkadot executes one of the most significant supply events in its history, reducing its annual new token issuance from 120 million DOT to 55 million DOT. That is a 54% reduction in new supply entering circulation. Whether this translates to price support depends on demand conditions, but mechanically, less new supply is a structural positive for existing DOT holders. And looking slightly beyond this week, the Federal Reserve's rate decision on March 18th is the event the entire market is building toward. The CME FedWatch tool currently shows a 98% probability of a rate hold at 3.5 to 3.75%. But the language in Fed Chair Jerome Powell's press conference and the question of whether Kevin Walsh, Trump's nominee for the next Fed chair, will signal a different policy direction will be passed word by every institutional trader on the planet. Tom Lee of Fundstrat, one of Wall Street's most respected macro analysts, told CNBC this week, "I would expect March to be an up month for the stock market. Things like software, the Mag 7, and crypto all had early weakness. They're all probably in the final stages or have already bottomed." That is a bullish call from a credible voice. But Jan van Eck, CEO of Van Eck, offered a counterpoint worth noting. Bitcoin goes up 3 years in a row, then goes down pretty massively in that fourth year. We are in year 4 of this cycle. Both views deserve respect. Now let me show you something that most analysts are not talking about. The institutional floor underneath this market. This is what makes the current correction fundamentally different from 2022. As of March 2026, spot Bitcoin ETFs hold a combined $130 billion in assets under management. BlackRock's IBIT alone holds approximately $67 billion, making it one of the fastest growing ETFs in American financial history. Fidelity's FBTC holds roughly $30 billion. Together, these two products hold over $97 billion in Bitcoin on behalf of pension funds, family offices, endowments, and wealth management platforms. Strategy, formerly known as MicroStrategy, holds over 660,000 Bitcoin, valued at approximately $45 billion. They bought 3,015 Bitcoin at an average price of $67,700 in late February, buying directly into the dip. Harvard University's endowment increased its Bitcoin ETF exposure by 257% to $441 million during the 2025 correction. These are not retail traders panic buying. These are fiduciaries with long-term mandates. And here is the most striking on-chain data point. Only 5.88% of Bitcoin's total supply currently sits on exchanges, the lowest level since December 2017. That means the overwhelming majority of Bitcoin is in cold storage, off exchanges, unavailable for immediate sale. The liquid float is tighter than at any point in the last 8 years. That is a structural supply constraint that provides a floor under the price, even as short-term sentiment remains fearful. Now let's talk strategy. Because information without a plan is just noise. Here is how I would approach trading the week of March 9th to 15th, 2026. Based on the technical and fundamental picture we have just laid out. The first principle is this: do not fight the macro. The CPI data on Wednesday is a binary event. Before that number drops, I would not be taking large directional positions in either direction. The risk-reward of guessing a CPI print is terrible. Instead, consider reducing position size going into Wednesday morning and re-entering after the data confirms a direction. If CPI comes in cooler than expected, below 0.2% core, that is your signal to watch Bitcoin test the 72,000 resistance level. A high volume daily close above 72,000 would be the first legitimate bull signal in months. That is your entry trigger for a long position with a target of 75,000 to 79,000 and a stop loss below 68,000. If CPI comes in hotter than expected, above 0.3%, expect Bitcoin to test the 65,000 to 65,600 support zone. If that zone holds with strong buying volume, it could represent a high-quality accumulation entry for patient traders. If it breaks, the next support is 62,300. Do not catch a falling knife below 65,000 without confirmation of a reversal candle on the 4-hour chart. For altcoins, the strategy is simple but requires discipline. Wait. The altcoin season index is at 35 out of 100. Bitcoin dominance is 56.7% and rising. Capital is not rotating into altcoins yet. The one exception worth watching is Ethereum, which Tom Lee specifically called out as a long-term buy. There's so much being built on Ethereum now. Almost every major announcement of a tokenized fund is happening on Ethereum. Ethereum at $1,968 is testing the 61.8% Fibonacci retracement level near $1,965. A hold of this level with a bounce could set up a trade toward 2,100. A break below 1,900 would open the door to 1,850. For the geopolitical risk, the Iran conflict, the rule is do not trade the headlines, trade the price action. As Santament's research team noted this week, avoid trading solely on headlines. Focus on whether on-chain volume supports the fear narrative. If Bitcoin holds above 65,000 despite escalating geopolitical news, that is a sign of underlying strength. If it breaks below 65,000 on geopolitical headlines, that is a sign of genuine institutional risk-off behavior. The token unlock calendar is also a trading tool. ARB unlocks $9.59 million on March 16th. ZRO unlocks $43.7 million on March 20th. These are known selling events. If you hold ARB or ZRO, consider whether you want to be holding through those dates. Historically, tokens with large unlocks relative to their float see selling pressure in the 48 to 72 hours before and after the unlock date. Finally, and this is the most important strategic point of this entire episode, the long-term MVRV ratio for Bitcoin sits at negative 28.5%. That means the average Bitcoin holder who bought in the last 365 days is sitting on a 28.5% unrealized loss. Historically, when this metric is deeply negative, it has marked some of the best long-term accumulation zones in Bitcoin's history. The short-term pain is real, but the long-term data suggests that patient, disciplined accumulation at current levels has historically been rewarded. As Fundstrat's Tom Lee put it, and I think this is the most important thing you will hear this week, they're all probably in the final stages or have already bottomed. That does not mean the bottom is guaranteed. It means the risk-reward for long-term positions is shifting in favor of buyers. So let me bring this all together for you. The week of March 9th to 15th, 2026 is defined by three forces. A geopolitical conflict that is keeping risk sentiment suppressed and oil prices elevated. A critical CPI data release on Wednesday that will either confirm or challenge the Federal Reserve's rate hold narrative, and an institutional Bitcoin market that is structurally different from any previous cycle, with $130 billion in ETF holdings providing a floor that did not exist in 2022. The technical picture says 72,000 is the line in the sand. Above it, the bulls reclaim control. Below it, the bears maintain their grip. And the on-chain data says smart money is watching, waiting, and accumulating quietly, while retail sentiment sits at extreme fear. If you found this analysis valuable, and I genuinely hope you did, please like this video, leave a comment with your thoughts on where Bitcoin goes this week, and share it with someone who needs to hear this before Wednesday. Subscribe to Boni's Life for weekly crypto market analysis that is accurate, honest, and built to help you trade smarter. Stay sharp, stay patient, and as always, do your own research. I will see you in the next one.